My name is Ed Walter, and I am fortunate to be the Steers Chair in Real Estate at the Steers Center for Global Real Estate at Georgetown McDonough School of Business. I am pleased to have the opportunity to welcome you to the latest edition of the Real Estate Luminaries series at the McDonough School of Business. We are very proud of this event, which is our annual on-campus gathering that allows us to highlight the strength of the real estate program at McDonough. It is also an opportunity for all of us to come together as a real estate community, inclusive of students, alums, parents, and friends of the school. As we are all well aware, the world today is a very interesting and volatile place with direct implications on the real estate industry. Our panelists and our luminary, Rick Clark, will delve into these issues this evening. I could not think of a better venue or group of people to help us make sense of where our industry is headed. We are very thankful that you have joined us for this evening's event. I would like to say special thanks to HFF, who is our lead sponsor this year. I'd also like to thank CREFC for this supporting sponsorship. And finally, I'd like to thank our Hoya Corporate Cornerstone members, Avalon Bay, Hilton Hotels, Host Hotels and Resorts, the RLJ Companies, Green Oak, Goldman Sachs, Joss Realty, UDR, and Vornado. We sincerely appreciate all of your support. Now, we've received feedback in the past that we need to get on with the show, so that's exactly what we're going to do. I'd like to introduce Matt Seifer, who is the director of the Steers Center for Global Real Estate and the Atari Kaufman Professor in Real Estate at the McDonough School of Business. He is also, as he's fond of hearing, my boss, and he'll be leading our panel through their discussion. Matt, take it away.
Thanks, Ed. We'll talk about that on Monday. Right. Anyway, I want to thank everybody for being here. This is, without question, the highlight of our academic year, and it's always beautiful in Washington for Luminaries. So we very much appreciate everybody coming, and I would expect you to be in for a treat here this afternoon. I am quickly going to introduce our panelists, but before I do that, I just want to kind of a housekeeping comment here. If you're interested in asking a question, we are asking you to pose that via Twitter using the hashtag SteersGlobal. I will not be disinterestedly perusing my phone. However, I will be looking at my Twitter feed to see what the questions are and screening those. So if you have questions, please pose them via Twitter using hashtag SteersGlobal. So we're very fortunate here to have three individuals with us covering areas of policy, equity, and debt as we think about and try to make sense of the world that we're in today. The title of this panel is Revolution or Chaos, Investing in a Time of Political Change. And we sit here in Washington, D.C. So what better place and what better time to have that conversation today. So with me and to my left, Jeff DeBoer, the founding president and CEO of the Real Estate Roundtable. Excuse me. To his left is Len O'Donnell, president and CEO of USAA. And to his left is Dennis Hsu, chief originations officer of the Starwood Property Trust and a proud Hoya of the Business School. So gentlemen, we are thankful you're here. We appreciate you making time for us today. And I'm going to start with Jeff, because he promised to be highly provocative, so let's go there. So Jeff, the stock market, including REITs, reacted very favorably to Trump's victory and the Republicans retaining control of the Senate. Primarily was a result of the fact that there was hope that the key legislation might be advanced in 2017, but progress, frankly, has been pretty slow. Articles today saying there might be a scaled-down version of the tax plan at some point, maybe. The infrastructure thing is taking longer than we expected. So can you give us a little sense for the outlook for meaningful legislation in 2017?
Well, I'll try and be provocative maybe. But first of all, thank you for inviting me here. Ed, thank you for inviting me. Before this, I thought a luminary was something you got to design within reach, to light up your backyard. But, so here we are. Look, I think about the markets moving after the election and about what people thought was going to happen and not happen on legislation is dramatically overblown. I think that a lot of the market movement and what you saw was just a view that maybe the tone and the nature of business in Washington was going to change a little bit, and it wasn't going to be so much, we're out to get you. And I don't want to overstate that, and I don't want to be partisan here because I'm not a partisan person. But I do think that the tone in Washington has changed dramatically towards business and toward people who are creating jobs and putting capital at risk and so forth. And it's more of a, how can we help you do that? How can we help economic growth? How can we help jobs? And so more so, in my view, than, oh, gee, when is tax reform going to pass? How much is my tax going to be cut? What about Dodd-Frank? Are we going to get rid of these onerous regulations? Or are we going to have a big infrastructure spending bill? You know, those are very, very important, but I do think that overriding all of this is the general tone that, that's associated with what's gone on here in Washington vis-a-vis the administration and business. And that's setting aside any personal viewpoints that I have or anybody in the audience has about individual things that are tweeted or are commented on or anything like that. But so first of all, I think that drove the market a lot. As far as things getting done this year, look, I don't think there was ever much of a realistic expectation on the people who were commenting on what was going to be done in the first 100 days. Tax reform in 1986 took about 3 or 4 years to get to where it was, and it wasn't just leadership by the president or anything like that. It was trust between Republicans and Democrats. It was trust between the House and the Senate. It was trust between Congress and the White House. And that trust was built up from 1982 to 1986. They did 8 or 10 tax bills during that time period, which created trust. We haven't had a tax bill in this town in a long time. We haven't had any legislation in a long time. So there isn't that trust. So the expectation, those of us who do this for a living, and you all do whatever you do for a living, and you see these, whatever it is, predictions in the press or somewhere, and you go, that can't possibly happen, because you know what you're doing. And when I saw these predictions, I said, that can't possibly happen because I know what I'm doing. And so it takes time for any of these things to occur. And I wouldn't necessarily have a scorecard, particularly on this administration, on what they've done in the first 100 days, because part of what they're trying to do is undo things. And so, it's a really an interesting game that's being played out there now about, is it a successful 100 days or an unsuccessful 100 days? I don't know. Let's wait and see, and let's let this stuff play out. Having said that, and some people here, some friends are here in the audience, and they know I'm a baseball fan, a baseball player. I love baseball. And Washington is sort of like Major League Baseball was in the late or early 1920s. And before 1920, it was a dead ball era. Everybody was hitting singles and bunts and doing nothing, 1-2 to nothing games. Along comes Babe Ruth in 1920 and hits 54 home runs, and pretty soon everybody's swinging for the fence. Now everybody in Washington is swinging for the fence. And just like back then, not every ball went over the fence. Not all these proposals are going to go over the fence. But there's a lot of activity going on. And whether it's on tax reform, infrastructure, Dodd-Frank, regulatory review, all kinds of things. So there's tremendous amounts of activity. There's a lot of people swinging for the fence. Is it going to get done this year? I'm a little doubtful, but I'm doubtful not necessarily because somebody's going to fail. I'm doubtful just because these are enormous questions. And I think that they learned a lot, and I'll stop because I know I'm going too long, but I think they learned a lot from the healthcare situation where, a small group of people talked to themselves for a long period of time and then came out and said, okay, let's pass this. And they never really had hearings. They never involved a diverse viewpoint to vet things, and it got shot down. And they set artificial barriers. We're going to pass this by, March 1st or whatever it was. So I think they've learned from that now as you go forward on tax reform, infrastructure, and these other issues. And I think they're going to be much more deliberate. I think that they will think things through a little more carefully, not set artificial deadlines. Whether they get it done this year or not, or next year, who really cares as long as they get it done right. For this industry, we've got a lot at stake, a lot of opportunities and a lot of risk. And I'm happy to be here because everybody should be paying very, very close attention to what's happening here.
So that's a perfect segue. So I'm going to go one more to you before we get these other guys involved. So the House Blueprint has two concepts that obviously impact real estate meaningfully. The immediate expensing of investments and the elimination of the interest deduction tax rather than a personal residence. So are those proposals positive or negative for real estate, and how do the various parties
Depends on where you sit in the transaction, doesn't it, boys? You know, well, first of all, they're very serious. And I'm not sure everyone really heard what you said because it is such a dramatic change in the way that people think. I've been doing this for 35 plus years. On behalf of real estate, if I would have gone up to Capitol Hill 2, 3, 5, 10 years ago and said, hey, let's expense buildings. Let's, in other words, take all of the cost and write it off in the year that we make the investment, people would have laughed me off the hill. Are you kidding me? You're not going to expense a building. But that's what the proposal is up there now, to expense all investments, not depreciate them, expense them, not deduct the interest on the debt used to acquire that asset. Is that good for real estate or bad for real estate? It does depend on where you're sitting. I think that, you know, on a going forward basis, new investment, you might say, well, it's pretty much a wash. Who really cares? It's okay. And that is sort of largely true. It's a pretty even trade-off in most situations. But we have $17 trillion. You guys own a bunch of it, so you know. $17 trillion or so of commercial real estate in the United States. It is capitalized by debt and equity that were put in place under a set of rules that Congress told them to do it. Depreciate a building over 39 years, depreciate a multifamily structure over 27 and a half, deduct the interest on the debt. Those are the rules. Now along comes a new set of rules. You know, as I said, it might be okay for new people and new deals, but what about that $17 trillion of invested capital in real estate? And that creates real concern to us. And it makes us want to think about, you know, what's this mean not only for individual investors in real estate, but what's it mean for local markets? What's it mean for lenders? What's it mean for people who invest their pensions into real estate? So this is big, big stuff. And I'll stop by saying this $17 trillion is roughly the equivalent size of the New York Stock Exchange. Now, no one would suggest that we're going to take the New York Stock Exchange and suddenly close it and have that $17 trillion of capital and not know where it's going. So this is big stuff, and I guess the other thing that I would just say, and I really am taking a long time, but these are proposals that are offered in a spirit of helping the economy, helping economic growth, helping jobs. And so we're trying to look at them in that spirit, and there's other things, denial of 1031 treatment, a new category for income on partnership income and so forth, taxation of partnership income. All kinds of issues, and you have to look at the whole thing. You can't just sit there and say, well, we're going to lose interest deduction. Oh my God, the sky is falling, because there's all this other stuff. So it's almost a full-time job right now, and it's a lot of fun.
Love it, love it. So I'm going to bridge over to you guys, Len and Dennis, just with this question before we get into more of the sort of the real estate meat. But are you guys worrying about any of this stuff? Is there any internal conversation going on within USAA or Starwood saying, well, crap, like we need to alter what we're doing or how we're doing things, or are there any?
No, because if it goes south, they're going to blame me.
Yeah, no, look, I think we feel similar to the way Jeff does. It's something, yes, we talk about it a lot, both at our level and at our parent company level. We are a Federal Reserve regulated bank holding company, right? So the regulatory environment in which we've operated the last several years has had a significant impact on our parent company, and that has absolutely trickled down to us. I'm hopeful Jeff is right, and I do tend to believe him, although I don't think it's been apparent yet at the bank level that there is a kinder, gentler environment, let's put it that way. There certainly hasn't been any regulatory reform. Nobody actually thinks Dodd-Frank's going to get repealed or anything else. But so I think that we are watching it. I think the whole tax reform question, we're active in Jeff's group, and I think like everybody else, we're going to wait and see what happens. There's not a whole lot of point, I don't believe, in adjusting strategy or tactics today based on what the latest rumor is in the Wall Street Journal. I think and as Jeff said, there's nothing you can do with respect, we have $18 billion of existing assets. There isn't a whole lot I can do about that when they decide to change the rules. So, but I think all you can do is be thoughtful about it, talk about it, have contingency plans developing. We do have a view that in terms of expensing, that over the long term, it's kind of a wash. But I think it's going to drive behavior for non-fundamental reasons for some period of time, and that's never a good thing for markets. It creates opportunity for some and challenges for others. So that's worth watching.
I'm just a debt guy, so I don't really have an intelligent answer on tax reform.
You have good
to be
parties,
totally, sorry?
You have good parties.
Yeah. So, no, honestly, I really don't have an opinion on tax reform.
Okay.
I think one of the topics that we'll talk a bunch about during the course of the panel is around regulation, deregulation, what impact that has. So I think we'll save a little of that thunder for later.
Well, so let's start with you on that one, since I made a bad joke. So you were hired at Starwood Property Trust within the last, so in 2016, after 17 years at JP Morgan on the CMBS side. So can you talk a little bit about the experience that you've had since you've been at principally a non-bank type of lender relative to where you were, and so what's that experience like?
Yeah, so JP Morgan is a world-class company. I have nothing but great things to say about it. My principal reason for leaving was to become an investor and morph to become an investor versus a banker at JP Morgan, which is really what I felt my sort of role was. So at Starwood, I'm surrounded by world-class investors, and I'm certainly been learning a lot about the business. The business at JP Morgan that I was responsible for was more an origination for distribution business. The business at Starwood that I'm responsible for is a balance sheet lending business. We want to own the risk. We're not regulated. We're regulated by our shareholders, but we're more investors, and we're not extensions of credit. We're not thinking about the business more broadly. We're really looking for good real estate investments, principally in debt.
So can you talk about that? As a general statement, your view on the debt capital markets, what are you financing today? What is the things you just won't touch?
Yeah, so we're much more entrepreneurial. We think about debt investments through the lens of an equity investor. So we're trying to fill voids in the market. We really can't compete head-to-head with JP Morgan, Wells Fargo, Bank of America. They have a much cheaper cost of capital. If they want to win that loan, they can certainly do it. But where there are voids in the market, where there are pullbacks in the market, those are areas where we think they're really interesting, where the risk-reward opportunity is actually very, very attractive. So if the banks pull back a little in construction lending, which was certainly a topic on Mark's panel earlier, we think that's a really interesting opportunity. The equity investment at the end of the day may not be great, and we may debate that a great deal internally, but from a debt perspective, we think that basis and where we are in the capital structure is a very interesting sort of opportunity for us. So I think a lot of people have been moving towards the debt space, and I think the opportunities, there's not a lot of low-hanging fruit on the equity side, that a lot of people, a lot of private equity, a lot of traditional real estate families have been looking to get into the debt space. So I think it's really a statement about more where we are in the cycle, and people seeing a really interesting risk-reward opportunity there.
So what's the sweet spot right now for what you guys are financing?
So we do anywhere from ground-up construction all the way to direct equity or preferred equity. I'd say principally we're a bridge lender. About 25% of what we do is construction loans. I think we'll do more of that in 2017 than we did in 2016. But principally a bridge lender where there's a business plan associated with the property. If it's an office building and it's 60% leased in a 90% occupied market, and the sponsor's going to reposition it, we're underwriting business plans, we're underwriting sponsors and their track records, and we're underwriting assets. So we have a view on that. We have people across the country that are tracking assets, tracking markets, who have relationships with sponsors that, we look for those opportunities. We look at where our basis is on those and just really try to underwrite a good debt investment.
Is there any, from a construction lending perspective, what do you guys, is it I mean, are you in multifamily any longer, or what, or is it industrial, or is it all of it, or what are you looking at principally, or is it across the board?
Really across the board. Our average loan balance is $100 million, so generally we're looking at bigger ticket deals. It's pretty hard to find a multifamily garden-style apartment that's a $100 million loan, but we'll certainly look at those opportunities. But I'd say on the construction side, we've done some really large construction opportunities in Manhattan. We're doing some ground-up, hospitality, which is a really tough sector. Our chairman and CEO, Barry Sternlicht, has a particular view around hospitality and a particular expertise, so it's something we can get our head around pretty quickly in terms of, is that a deal that we like? Is that a deal we want to be associated with on the hospitality front? So we don't redline any particular asset classes. Obviously, there's plenty of asset classes that are a concern right now, and those are sort of pretty obvious to everyone, so we're no exception from that from a credit perspective.
So Len, let's talk about just the general concept of liquidity. And, I think you're going to spend most of your time talking about the equity side, but unbeknownst to me until we talked earlier this week, you guys own Square Mile, so you guys know the debt space pretty well also. So could you maybe give a little sense of this, just where you see liquidity today for real estate?
Yeah, I think, and for those of us that heard Mark, I think some similar comments. First of all, let me just preface everything I say by, we've got 15 or 20 minutes here, so trying to make broad general statements about a very complex market. I'm going to try to sort of talk about the broader market, but there are exceptions to everything, right? So, but I think in the previous cycles, I've been doing this for about 30 years, in previous cycles, it was, you look certainly in the rearview mirror, you can see it's largely been about credit, right? Credit tightening, values good. Credit tightens, values go down. There's opportunity emerges for equity investors. Credit loosens, prices go up. It gets tougher to find opportunities. There's a lot of things going on today that look like that, right? The banks are pulling back. There's there's a little bit of overbuilding going on in some markets. People are generally more conservative. There's a defensive posture amongst all of our investor base. But there are also several other significant sources of liquidity that have emerged that are new to the marketplace. So things like our respective private debt funds. Our story, I won't talk about debt, is very similar to theirs, except that we're a middle market player. Our average loan size is $20 to $25 million, specifically so we don't compete with Dennis and Blackstone and people like that, right? So, but basically the same thesis. But so you've got so banks have clearly pulled back from construction lending, from value add lending, and all of that is driven, I think, more by Basel III than by Dodd-Frank. That's why I don't think that's going to change. So a real quick snapshot, I think that's here to stay. CMBS is reemerging, but I don't think it's going back to $200 billion that we saw in 2007. Life companies have a robust appetite, but again, stabilized, well-leased assets. So there's very little liquidity from conventional sources for construction and value-add lending. And that's where the private debt space, the private lenders are starting to fill the void. Are they significant enough yet? I mean, in one sense, we look and we say, well, there's tons of competition. We've been doing this now for 4 or 5 years, and it seems like everybody is starting a debt fund. But I'm still not sure there's enough liquidity to replace what's going to be sucked out of the marketplace. And then on the equity side, though, when you look at liquidity, I think you have this really sort of interesting mix. One, I agree with what Dennis said. I think you do have more and more investors. Our investors certainly are looking for a more defensive posture. Right, so there's more focus on debt, there's more focus on preferred equity, trying to stay away from that last dollar exposure in the marketplace. At the same time, we have pension funds and other people increasing their allocations to real estate. And then again, conversely, you've had a market where pricing has largely been driven by very aggressive foreign investors. We personally have a view that's curtailing a bit. Right, I think for a couple of reasons. I mean, as we go around, I think 1, they are more defensive. 2, I think they see there are fewer opportunities in the U.S. 3, I think some foreign investors are starting to think there may be more attractive opportunities elsewhere, whether it's Europe or Asia or whatever. I've had a small handful of investors question whether the U.S. is really a safe haven, given some of the political turmoil. I think that will quiet down. And then lastly, several very significant sources of capital for the last 5 or 6 years simply have less capital, right? The oil-rich countries, China with some of the limitations on outflows. So I think there's, that explains, I think, some of the slowdown in transaction volume. So sum up the whole answer, there's a little bit of caution, maybe a little less flow on the equity side. The banks are significantly curtailed in their lending activities in a couple of areas. The market is trying to fill that void. I feel like there's less liquidity in the market. I think that manifests itself in lesser transaction volume today. The question is whether the private market and the private equity market is going to be able to fill that void in the debt market to stimulate the market again. We personally have a view that it won't in the short run, and that values will recede somewhat in the next couple of years. Not a 2008 event, but we think we think broadly the market's down 3 to 5% today as compared to a year ago. But again, I can give you 100 examples where that's wrong, and cap rate compression is continuing in a few spaces like core industrial, right? But I think it's generally down 3 to 7% today. I think it ends up down 10 to 15% in a broad section of the market, and then the market sort of stabilizes from there, unless we have a meaningful world event or some increased recessionary pressure.
So if we suck the core industrial out of the conversation for a minute and just think about core X that, and again, I'm asking for a broad statement and it's not fair, but from a repricing of that product, it's been very aggressively bid for so long from domestic and foreign and everybody. Has that been meaningfully repriced in that 3 to 5% as your
Things
reference?
other than industrial?
Yes,
Yeah,
that are core though.
Yeah, I think less so. Again, similar to what Mark said earlier, there certainly are going to be plenty of examples of that property that fits right in the sweet spot for everything that everybody wants, well leased. I look at I look at core as, to a certain extent, what's the risk of volatility? What's the risk of loss of cash flow? What's the risk of loss of value in the short to medium to long term? And I think if you stay in that sweet spot, there's going to be plenty of bidders, and there's good pricing for it. I still would argue that there's fewer bidders than there were a year ago or certainly 2 years ago. And anytime there's fewer bidders, I think there's risk of price recession. So I think across the board, I'd say, I think there's less frenzy for assets, and there's maybe instead of having 4 or 5 bidders really slugging it out at the end, you've got 1 or 2, or you've got 1 and you tell them you're going to a second round, right? I think that's, so I think that there's got to be we personally have a view that there's just a little bit of pullback there.
So just to stay with you for a moment more. So in your seller interviews on the core stuff that you're moving, are you finding the buyers sort of reacting to a broker whisper, or are they sort of holding tight at their initial bids? Is there any sort of commonalities that you can talk about from your view of the buyer community?
Yeah, we've sold $9 billion in the last 4 years. We're going to sell a lot less of this year, right? I think because I think we do have a view that there's. I know Mark's upset with me about that, but it's. I think our view was that we wanted to monetize some opportunities when value we had created, and then sort of build this sort of fortress portfolio, waiting for a little bit of a downturn. So I think that's the case right now. That said, those things that we are selling. I think what we're seeing, I don't know if this answers your question directly, but fewer bidders. Those bidders that emerge, if it's not sort of that really perfect core property where you have the major institutional purchaser base that doesn't need debt, that's ready to close all cash, close in 30 days, there's still that out there. But anything that's slightly off that center beam, we're seeing people come back and ask for more time. Taking a little bit more time to get their financing together, finding out that they're not getting bids from their conventional lenders. And we're just, I think for lack of a better, we're still getting the numbers we more or less want. And I say more or less because we're still generally beating our internal valuations. We're not blowing through the broker opinions of value the way we were 2 years ago, right? Where every transaction, shocked you, right? But I think what we're doing is nursing them to the finish line.
So Dennis, obviously interest rates have a meaningful impact on the mortgage REIT space, right? So we're heading up. I assume that's the general belief. So what do you guys think about that relative to your business model?
Well, maybe they're heading up. I think if you look back a year ago, I think the 10-year Treasury is almost on top of where it was. So obviously it went up, it's come back down. I think, but historically they're still at very low rates. Interesting, our business and our loan portfolio is actually 98% LIBOR based. So we're really, we think, actually well correlated with higher interest rates. And 1-month LIBOR has gone up 75 basis points over the last year, so we've actually benefited from it. And we will continue to benefit from higher, LIBOR rates as the Fed is expected to continue to tighten. So, I think when we think about higher interest rates, we're more thinking about impact on cap rates, impact on valuations of commercial real estate, and thinking about it from a lender's perspective on sort of exit cap rates. And if we're starting at a weighted average for our portfolio around 65% or so, if we sensitize that and we do a bunch of metrics around that, what does it look like in 24, 36 months if cap rates are 50, 100 or so basis points wider? What does our portfolio look like? So I think we're more focused on higher rates from that perspective. I think we actually like higher rates from the perspective of our existing portfolio. I think higher rates is likely the result of a pro-growth environment and inflationary pressures that will likely be a good thing for commercial real estate values and likely curtail a bunch of development besides some of the backdrop that we've just talked about with a lack of construction financing that's sort of out there. I think that generally sets a pretty good stage for commercial real estate values. And if we are in a higher interest rate environment, likely we're seeing increased sort of property cash flow levels, and I think we're feeling pretty good about where we sit in the capital structure.
Please, please.
So Dennis, I agree with everything you said in terms of our book, in terms of the existing portfolio and the benefits of LIBOR increasing. But are you seeing in the larger loan business that spreads have largely come in matching that increase in LIBOR?
Yeah, for sure. I think it goes back to the statement earlier about, people are definitely leaning into the lending business, and I think are accepting a little bit lower returns than what was out there. I think people are feeling pretty good. I think if you harken back a year ago, the world was ending, whether it was, China or energy, oil, you name it. People were really scared. And I think if you think about as 2016 played itself out and a lot of uncertainty with the election, there's just a lot of uncertainty in the market. So we were certainly cautious in early 2016. I think we're certainly a glass half full perspective as we sit here today, without a doubt.
But I also think partly the debt business. Well, I'm an equity guy, so I've been slow to learn this debt business. But
it's easy.
But yeah. So that says something, doesn't it? But in any event, I think of it as I think to me, it's becoming clear that it's a nominal return business, right? So sort of think about it as it's a 10% business, and to some extent, going back to my comments on value, if the cost of debt just keeps going up, then values have to come down, right? Because if you're, as Mark said earlier, if banks are sort of stopping at the 40% level in construction lending, and now you're filling the void from 20 to 65, and equity's going from 65 to 100 in the capital stack, and you used to go 55 to 75, and given you're charging 700, 800 over, I can pay less for the asset. So nominally, that you can't just follow, the rate can't follow LIBOR up, or the business is going to price itself out.
Yeah, I think spreads have probably compressed 50 or so basis points year to date 2017 as LIBORs continue to rise.
Right, but nominal rates are about the same.
Nominal rates are about the same.
So Jeff, I'm going to come back to you and maybe change gears a little bit. So can you talk specifically about the infrastructure bill, both in terms of scale and in terms of timing?
Sure. By the way, if they do away with the deduction for interest on debt, the debt's going to go up in price, right? So the values are going to come down. On your comment, Len, about banks and Basel III and the limitations they're having on construction lending, that is true. It's not Dodd-Frank. It's Basel III, and it's some of these other things that are layered. There's a whole bunch of them that are layered on top of each other that are impeding a lot of community banks and a lot of development and acquisition lending. But there is legislation that wants to correct that on Basel III, and it actually has legs, by the way, outside of Dodd-Frank.
For smaller banks or all banks?
For smaller banks.
Yeah, right, only for regional
Yeah.
banks.
So what's that? Infrastructure. I think, there again, look, people, they have in their head, we're going to spend $1 trillion and rebuild every road in America. And I think that reality is set in a lot on this. And I think, first of all, the infrastructure bill might focus, on the permitting process, look, the permitting to do any of these infrastructure projects across America is so strenuous and so inefficient and so time-consuming and so costly that if you could somehow streamline this stuff so that there wasn't 10 or 12 agencies overlapping each other, building on, again, multiplicity of time and effort and energy and cost and lawyers' fees and blah, 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 that would bring some of the costs down from this $1 trillion that everybody talks about. So I think the first thing when you see an infrastructure bill, I would think that this permitting, streamlining permitting, getting a more general agency that can oversee people. This occurs now in some of the Endangered Species Act stuff that goes on, where you used to have layer upon layer of bureaucracy overseeing things. And they sort of got it together a little bit in that area. And I think you're going to see some of that from the administration, that they'll try to do that. And why not? Because the Infrastructure Advisory Group is headed by two real estate developers, big real estate owners, big real estate developers. And they know what it takes to get a big project permitted and from start to finish through. So I think they're bringing that mindset to this discussion and saying, wait a minute, we can do a lot by streamlining things. And then they got to find a little bit of cash here, don't they? Because you have to have some money to do things. The highways and infrastructure have always been funded by the gas tax. The gas tax has not been raised since 1992, I think. So, they could raise the gas tax a little, but they're not going to raise it that much to get $1 trillion. So where's the money going to come from? Well, they could, encourage some of this cash that you hear about corporations. Corporate America has, I don't even know what the number is now. It's a huge number, maybe $2 trillion, something like that, parked overseas where they're not bringing it back to the United States, because if they bring it back, they'll be taxed here. And so they have it over there. And the idea is to allow them to repatriate that money at a very low tax rate, maybe 5 or 10%, and take that tax money and capitalize an infrastructure bank, and then lever up the infrastructure bank from that tax money, and then you have some real money that you can start spending. So I'd look at permitting, I'd look at this repatriation infrastructure bank idea, and then the final thing that is really, really important and valuable for people in this room, I think, is where do public-private partnerships fit in all of this? And how can, there's a lot of capital, right? A lot of capital that wants to play if they can figure out how to get a return on their investment. Some infrastructure projects don't provide, much of a return, but a lot of it does. And if you can have a revenue source from an infrastructure bank to then go and help public-private partnerships come together, you can do a lot of things in there. So, I guess I would say the three main components would be, this permitting, streamlining, public-private partnerships, capitalize an infrastructure bank of some way, shape, or form. And, the bottom line is there's got to be some overriding czar or something like that sorts through all of these needs out there and decides what's spent if we do go down this road of an infrastructure bill. It's going to run into a lot of problems, because, well, I'll just leave it at that, a lot of problems. How about that? Yeah.
So
nothing's easy,
This whole streamlining process, it would strike me as virtually impossible. I mean, do you think there's any validity to that actually happening?
I do. Oh, yeah, I definitely do, particularly with the mindset. A lot of this permitting and for national projects, for big projects, these are national federal agencies. Everybody's got to have a piece of the action. The EPA, you go on and on, DOT, and all of these people have a little piece of action. So you have to get approval there, then you go there, and you have to do something different for. So I think that with the mindset coming from above, and arguably the above in this case has experience in doing large development projects, and they're going to get advice from people like that. So I do think that there's going to be a strong movement there. Now, the system's not going to like it. The system doesn't like it. The system wants to keep their little action and keep their piece of pie, and I want to be able to approve, that. And what about the impact on this fly and that, whatever it is. And so the system doesn't like it. But if the direction from above, and in any of your businesses, if you guys direct things to happen, sooner or later the culture is going to allow that to happen. And as I said, there is some precedent for, for this kind of thing. And by the way, we've seen it a little bit here locally when the Wilson Bridge was done, when it took a while, obviously, but we had 3 jurisdictions. Everybody had to have their piece of the pie, and everybody had to feel like they weren't getting paying too much or what have you. And so Virginia, Maryland, and D.C. had to get together, and it's the same thing when you look at these agencies. So I don't think it's all that outrageous to suggest that we can streamline this review process. We can make it simpler. We can make it quicker. The president held up a chart the other day at the White House that he had a guy hold it up and drop down to the floor, and they said for a typical highway project, it took 12 years to get it approved. Now, come on. That's a little bit crazy, right? So, and 12 years would increase the cost. It would, all of these things. So, I don't think it's crazy to do this. And the chairman of the House Transportation Committee, who has a lot more say in this than I do, doesn't think it's crazy either.
So Len, let's go back to you. So you recently got $800 million from Germany's biggest pension fund, BVK, for a multifamily vehicle. And if I understand it correctly, a meaningful amount of that capital would be allocated to value add and development of multifamily. So can you talk a little bit about the global capital mindset vis-a-vis this group, your thoughts on multifamily at this stage in the cycle, development period? Is there the renovation plays that people have been doing for the last 7 years, does that stuff even still exist? So what is, I mean, obviously you think it does or you wouldn't take it, but...
So you want that in about 30 seconds? So first of all, the BVK transaction is a portfolio of about $1 billion portfolio that we controlled, that we largely developed. And we sought to recapitalize with the help of our friends at HFF, and I think did so fairly successfully. And what we were looking for was a like-minded investor that had a similar view to ours in regard to the future of multifamily in the U.S., notwithstanding the fact that they are what you might call more of a core buyer, right? They're coming in after we had created value, but with an idea that we were going to build together a platform. So that what the idea behind the platform was, the existing $1 billion or so portfolio gives them a base. We retain a significant equity stake in the portfolio. It gives them a base where they're generating positive cash flow, meeting their targets early on. But then forward, they would participate in the upside of development and value creation. We are 100% a value creation investor, whether that's through development or value add. We buy almost no core, and except in a downturn, and we, as we did very actively in 2009, 10, 11, we more or less stopped buying anything from you'd consider core stabilized in 2012, 2013, right? So with that, I think we do have a very positive view about multifamily long term in the U.S. There's clearly some markets today that are being slightly oversupplied. I'm not, and we've pulled back in some of those markets. And then we've pulled back in some markets like San Francisco because we're a little bit concerned about affordability, right? The ability of the target renter to actually afford to live in them. And this, this is where sometimes it's interesting, a quick aside, being in the debt business and the equity business, we recently looked at 2 construction mezz loans in San Francisco, and at 65% of the capital stack, our basis was higher than it was in the last project we delivered in San Francisco as an equity investor, and a project that delivered in 2015, right? So that gives you an idea of, where that market has moved. But, so I do think there's some reason for concern. I think we're going to see vacancy. We've had these incredible vacancy rates, 3-4%. I think they're going to slide down to 7 or 8%. But, sort of full stop, we've already just talked about banks are out of the construction lending business. Private sources of capital are, really equity investors are driving the construction debt space. And equity, the large providers of equity into the multifamily development space are relatively few in number, You know, if you really break it down, there's probably, Mark, 20 people that are driving that market. They all know each other, and there's so much more data in real estate than there was. Look, we all grew up in a business where we had constantly overbuild the market, but there was no data, right? We're awash in data today. We know what these markets are. We know what the supply chain is. We know what projects are planned and proposed or whatever. So I don't have a huge concern about overbuilding. And then when you look at the demographics, right, we still have constraint on homeownership. It's still harder to get a mortgage. Interest rates are rising. Young people are waiting longer to start, for household formation. There's this whole intriguing debate we don't have time for today about whether millennials are going to ultimately just do what every other generation has done and buy houses and move to the suburbs, but there's no debating that they're not doing it till they're 35, right? And then for the first time in American history, we have a generation following the millennials that's larger than the generation before it, right? So we're going to go from 80 million millennials to 85 million Gen Z, as opposed to when the boomers went to a much smaller Gen X, right? So early on, until that started materialize, going back 5-6 years, I was thinking, geez, are we building a bunch of apartments nobody's going to want in 15 years? But you've got another 85 million person cohort coming up behind it. And the U.S. still has a significant amount of immigration. There's going to be 400 million Americans in 2050. So I feel really good about the long-term aspects of multifamily. That said, we did 2 years ago stop building in what we consider to be tactical markets, places where we were largely building and selling, and taking advantage of cap rate compression. We've been focused on what we call, the same thing everybody else does, build to core markets. We're pretty focused on basis. And so you'll say to me, well, you just said before everybody's defensive. How is continuing to develop defensive? But I'm building for 75-80% of what people are buying for. And, there's a few projects that we'll deliver. Rents will be a little lower than we projected, or, cap rates will be a little higher in the short run. But as we build out a long-term portfolio with a partner like BVK, I think we have a longer view than that.
So a question for all three of you. So we sit here in Washington, D.C., and President Trump has made it clear his focus is on the military, and there's sort of less focus in other parts of the government. What is your view of Washington? Your view of Washington today as an investable market, as a general statement, and are there sub-property types or even the niche markets, sub-markets where you are interested today?
It's directed at me?
Or so both of you guys. What do you think of D.C.?
You go first. I'll shut up for a minute.
I think the natural reaction is, drain the swamp, and, Washington, D.C. is going down the tubes and cut all this federal spending. But I think when you cut through, all the sort of data, you realize that the amount of the reduction in spending is actually very, very nominal, and a bunch of the sectors are growing, whether it's defense and others. So it's really just a nominal sort of decline. I think when we think about the real estate that we'd make a loan on down here, generally, we're not lending in a lot of buildings that have GSA type of tenants in them anyway. So we think it's actually interesting. We studied a bunch of data where if you look where the White House and the Congress are aligned in the same party, there's actually a tremendous amount of bills that get passed, and there's actually a tremendous amount of positive absorption in terms of just space in the district. So if you look at sequestration, when nothing happened, there was actually a pretty dramatic increase in vacancy. So we actually think it's a little bit overblown, and I think it's a little bit of just sort of political rhetoric. So we've done actually recently 2 deals, and the sponsors in the audience, the Meridian Group, we did a really interesting deal at 700 K Street, awesome location, great sponsor, great sub-market within DC. We love that particular deal. We think that is, a sort of an area within DC that's going to have, a tremendous amount of growth. We love that deal. That was a $250 million deal. Got rehab, will be a trophy office building in, 24 months or so. And we just did a really large deal out in Tyson's Corner, which was more of a stabilized deal. There's definitely been a fair amount of rent growth in that particular market, and in particular around transportation, and we thought it was just a unique location. And defense spending certainly in that market, we thought would benefit from it. So we're if people are a little bearish on a particular market, we actually think we can sort of find some opportunities there and find some voids. We'd rather not be where everyone else wants to do the particular deal, because generally you're not getting paid for that risk. And we're not really that core lender. We're not that type of capital, so we can be a little bit more opportunistic about deals that we look at.
Glenn?
So I'll caveat this by admitting that I spent 26 years living and working in this market, so I might have an antiquated view to some extent. And I'm also going to split my answer into two parts. We run a government building fund, right? And so we have about $2 billion of GSA leases in the city. So we watch government demand and talks of government cuts. We own the EPA's headquarters, so we're focused on that. But you know, they've shrunk over the last several years, and we've backfilled their space. So we actually, you know, think we own a pretty good asset there. That said, the focus of that fund is to own Class A buildings into which the government consolidates. And generally speaking, our tenants, the tenants that occupy our buildings, represent a significant reduction in overall space for that agency. So we think we're a facilitator of some of the consolidation that you might want to see in Washington. And I think you still focus on the fact that 65% of the space the government occupies in Washington, D.C. fails to meet its own standards for tenant occupancy. So I think there's opportunity in the space, even if there's attempts to cut, you know, small amounts out of the budget. A broader view of Washington, I think there's been a little bit of, it's one of those markets where maybe there's been a little too much multifamily. We're not concerned about that long term. I think that we have a broader view, and there's people in this room that know a lot more about it than me, but a broader view that office demand is not what it's been historically. And I think to me, the answers are, you know, look, what's driving the U.S. economy, right? Healthcare, education, and technology. And those are not driving components of the D.C. market. So I'm, you know, from an office standpoint, you know, we think there's some turmoil in the law firm business, talking about that with a couple of people earlier. So I think there's things to watch, but look, at the end of the day, it's Washington, D.C., and it's not going anywhere, so.
So we've got, call it 3 minutes, and my last question is of you to the students. So we have a meaningful student component in here. So what is the one thing you wish somebody would have told you at 21 years old that took way too long to figure out or cost you a lot of time and money? Jeff?
I don't know, buy Host stock.
Or Apple stock.
I guess I'm not really sure. I mean, I had some very, very good advice when I was that age, which was basically, you can do anything you want to do, just show up, work hard, pay attention, and try hard, be honest. And to me, that's really the component in whether you're in my business or your business or whatever business it is. So I'm not looking back and saying somebody should have, gosh, I wish somebody would have told me that. Well, I do have one thing, because
By the way, I did say we had 2 minutes, right?
when I was growing up, I thought it was very, very
Dean, I don't have
important
to answer this
that
question.
you had hair. And I've come to learn that it's not all that important.
All right. Len?
So I'll answer from a real estate perspective. I spent the I spent the first 20 years or so of my career between brokerage and then development, focused largely in office, and I think office. You come to learn that office is the most volatile component of what we do, and I have friends that did really boring stuff, like started buying apartments 30 years ago and just letting the rents grow 4 or 5% a year and refinancing them every 10 years, and they have a lot more money than I do. So.
There you go. Dennis?
I think the real estate business is for sure a relationship business. And people do business with people that they know, they like, they trust. Those relationships, your network, are the people that actually bring you ideas. And it's sort of it's those group of people that help you find those sort of rare opportunities or help you sort of be a little bit ahead of the curve. There's lots of smart people in this world. There's lots of information out there, but it's actually that network of people that find those opportunities and help people get a little ahead of the curve.
Excellent. Well, if you could join me in thanking the panel here.